Hey guys, Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that help me build up a sizable portfolio in about 2 years and now manage that portfolio. Today, guys, I want to talk about the difference between stocks and real estate. I get this question a lot about should I invest in stocks or should I invest in real estate? And I want to kind of debunk, some people think that stocks come out way ahead, some people think out real estate comes out way ahead. In the long run. And I just want to show you, well, one, it's super individualized, but on averages, I want to show you kind of the comparison between the two. So that's what we're going to cover in this week's video. If you guys enjoy this, if you like this stuff, please like, subscribe, share with somebody. It really helps us out. If you don't like it, let me know, comment, give me some constructive feedback. That would be fantastic. So let's get into this. Stocks or real estate? The age-old question here. I did a little comparison. Now, there's a lot of assumptions in this stuff, so bear with me. I could pick this apart as well, but this is kind of the best that we could do with what we have. So we're going to assume that you have $500 a month to invest, $500 a month, and you're going to either put it into stocks, and the 100-year average is right around 10%. So we're going to assume some general market index fund like the Vanguard S&P 500, the VU, or the VTSAX, something in the stock market. You're not trading in crypto and all this other shit. You're actually just putting in a general market fund that's going to return 10%. Real estate, on average, we're just going to look at appreciation because cash flow is too hard. It's too variable, and a lot of cash flow gets eaten up by capital expenditures anyway. So we're just going to look at appreciation here. Now, I know for some of the cash flow investors are going to lose their mind over this, but just bear with me and walk through this. So, year one, you have $6,000 in the stock market. You have $6,000 in cash, because really $6,000, unless you're doing some sort of wholesale strategy, even then it's difficult. We're going to assume you have just $6,000 at the end of the year. In 5 years, with, again, this is compound interest and whatnot, you're going to look at about $36,000 at a 10% return. Over here, we have our $30,000. That's $6,000 a year for 5 years is $30,000. We're going to put that into a $300,000 house. Now, for some of you might be saying $300,000 doesn't buy shit around here, and for some of you might be saying, oh my God, $300,000 or $30,000, that's a lot. And how do I come up with that 10% down payment? So assume that you can get some sort of conventional financing that's a lower than a 20% down payment. That's what we're going to assume just for this. That some sort of house hack, whatever it is, it's going to be about 10%. Again, we're not including cash flow, so you could buy this and live in it. But we're just going to assume you put 10% down for even numbers. So you put all that $30,000 into a $300,000 house. So 5 years, $36,000, and basically 30. So the stocks are coming out ahead. In 10 years, you're going to have $95,600 from stocks, and over here you're going to have another $30,000 from the 5 years that you've saved up. That you're going to buy another $300,000 house. So you're going to do is another 10%. Now, again, you might be saying, Cameron, how do I do this? I've done 100 videos on this stuff, on trying to get in under less than 20% down. There is so many more resources out there now. You can figure it out. If you've got to move into it yourself and use a low down payment option, that's fine. Or use a second home loan. There's all sorts of different options, but you can find one for 10%. That's not that hard. Now, the price point might be different. You might have to go up here, but still, I just want to use even numbers, and I know prices are going to go up over time, as we're going to see. So our $30,000 from these 5 years is going to go into another $300,000 house, and the house that we bought at year 5 is now worth at 3%, $348,000, minus our $270 because we had to get a loan, leaves us about $80,000 in equity. Now, I'm assuming we're not going to have any debt pay down. We're just going to do interest only, or hey, I've got to take some money out because I got a roof repair or something. I just want the real estate to not get, I see a lot of people saying, oh, it's going to make $200 a month cash flow. It's going to do this and that. Oh, you're going to pay down the loan over this time. Let's just assume that the loan balances stay fairly the same. And if not, yeah, okay, you pay it down a little bit over 5 years, but maybe you had some expenditures or something come in. So you're going to have about $80,000. Now that 78 plus that 30 is 108. So at the 10-year mark, now real estate is slightly ahead. At 20 years, stocks, 10%, you're about $350,000, $343,000. Real estate, your first property that you bought on year 5 is now worth $470,000. Again, I'm not giving any loan pay down to this. Maybe you do a cash out refi, that'd be fantastic, whatever, but I'm not going to include that in this calculation. So you got about 200 in equity here. And also the argument comes in, well, I've got 200 in equity. Yes, but you're going to have to pay about 8 to 10% in closing costs. You're going to have to pay realtor fees to sell that. You're going to have to list it. You're going to have to pay title fees. There's all sorts of stuff you have to pay to access that 200,000. Even if you want to get a line of credit, you're going to have to do something. So that's not really 200 grand. So I'm being conservative here, is what I'm saying. This should be generously at 3% national average, which some markets, if you invest in a decent market, it should be more than that. You're going to come out with about 200 in equity from that property you bought at year 5. That second property that you bought in year 10 is going to be worth about 400,000. Minus 270 is again 130 grand. The 60K in cash that you have from these 10 years, the 200 and the 130 equals about 390. So you've got stocks at 340 and real estate at 390. So for you, what does this tell you? For me, this tells me that they're not that much different. You're over the long haul. I mean, this is a 20-year period. There's a lot of assumptions, and y'all, I know anybody can pick this apart. I could pick this apart, but we did the best assumptions that we could. The more you leverage, the better it's going to be versus stocks. If you bought cheaper properties at 100 or 150,000, those returns are going to be high because you're at 3%. If you leverage less, if you put more down, the value here and the big thing in real estate is leverage, that debt. Because you're making 3% on a $300,000 house. You're making $9 grand a year in appreciation versus I only took 36,000 over here and I'm only going to make at 10%. I'm going to make $3,600 a year, which is great, but I'm making $9 grand over here because I've leveraged. So the more you leverage, the better this will be, but there's also a lot different time involved. In this, if you set up an index fund, you will never touch this. You can withdraw $100, $5,000. You can sell Monday through Friday, and that money will be back in your bank account. This 390, one, it took some work. You had to find a property. You had to go through all the lender requirements. You had to have them pull your credit. You had to do a home inspection. You had closing costs. There's things you had to do to get these 2 properties. Now, this is just 2 properties over 20 years. For most people, this is a pretty solid nest egg, at least to start. You know, if you start this when you're in your 20s, $500 a month is not a crazy amount of money to save. So if you start this in your 20s, in your 40s, you're going to have $500,000 and 2 properties, not including the cash flow coming from them. Again, maybe you live in them, whatever. I don't want to include that right now. So this is more time involved. It comes out slightly ahead. And again, you can beat these averages if you use your competitive advantage. If you're a contractor, you can fix these up. If you're a property manager, you can manage these. If you're a realtor, you can sell them and save that cost. Over here, you're not doing anything. There's no competitive advantage to the stock market, none. And don't try to beat it. You can't. I've tried. I've seen numerous books of people that make hundreds of thousands of dollars every hour that they are awake. These billionaires that make hundreds of thousands of dollars literally every hour. They cannot beat this. So passive index fund, low cost, you don't do anything. You're going to have a little less money, but you're going to have no time involved, and it's very liquid. So the more time involved, I think you're going to come out slightly ahead. The less time super passive, you're going to come out not as great, but still in a really good situation if you have the discipline to invest $500 a month. So guys, what am I trying to say here? What is all this for? I don't think you can go wrong with either one. I think if you put some of your money in stocks in a good index fund that's low cost, and you put your money into some great properties that are going to appreciate over time, that are going to slowly cash flow over time, that you're going to have a fantastic portfolio here. You know, if this would be looking at, if you had both of these, if you had $1,000 a month to invest, put this in your 401k and IRAs, and then put $500 a month into real estate. Look at that. I mean, now you've got almost a $700,000-800,000 portfolio, and these are a great balance. I think I mentioned before, I love the fact that stocks are liquid, low involvement. Real estate's not very liquid, but there's a little bit more involvement, but you can control the returns. So it's good to have these both. I didn't even get into the tax advantages and all other sorts of things that you can do by owning real estate. So I don't think stocks and real estate is an either or question. I think you need to be in both. I mean, that's Cameron's opinion, so take that for what it's worth. I am in both. I invest in stocks, have for well over a decade, probably 15, coming up on 15 years. And then I also have been investing in real estate for about 10 years, just over 10 years. So I think both is a fantastic mix for many, many reasons, but this is the math behind it, y'all. I don't think you're gonna be down if you're like, real estate's not for me, I just wanna invest in stocks. And you're not gonna be that much further ahead by investing in real estate unless you can beat the averages and you have some more competitive advantages. So I love real estate, but I also love stocks. I hope that was helpful, y'all. If it wasn't, let me know. If it was, let me know. If you guys wanna ask some questions about this, pick it apart, just let me know, comment below. Appreciate y'all. See you next week.